Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoen, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're discussing an interesting development in the mortgage market, the comeback of variable rate mortgages. The recent rate cuts by the Bank of Canada have brought 5-year variable mortgage rates on par with their fixed rate counterparts. This raises a critical question for borrowers. Is now the right time to consider a variable rate mortgage? With further rate cuts anticipated, variable rate mortgages are becoming more appealing. However, they come with their own set of challenges. Borrowers must weigh potential savings against the risks of market volatility and the uncertainty of a possible trade war with the United States. Ron Butler from Butler Mortgages has described the current bond market as the most volatile he's ever seen, comparing it to the 2008 global financial crisis. The Canadian 5-year bond yield, which often dictates fixed mortgage rate pricing, has seen a significant drop from 3.85% in April to 2.64% recently. This decline, coupled with 6 consecutive rate cuts by the Bank of Canada, has made 5-year variable rates nearly equivalent to fixed rates for the first time since November. Many clients are now opting for variable rates despite the volatility. Market projections indicate at least 2 more quarter-point cuts by the Bank of Canada this year, potentially lowering variable mortgage rates by an additional 50 basis points. Some analysts even predict more aggressive rate cuts to counter the economic impact of a potential trade war with the United States. David Larocque from Integrated Mortgage Planners suggests that the Bank of Canada could reduce its policy rate from 3.00% to at least 2% in this rate cycle. However, he warns that rate hikes might return if inflationary pressures resurface. Larocque advises borrowers considering a 5-year variable rate to be prepared for possible rate increases during their term. Interestingly, data from the Bank of Canada shows a rise in variable rate mortgages, with nearly a quarter of new mortgages being variable as of November, up from less than 10% earlier in the year. This trend is accelerating, with Ron Butler reporting an increase in variable rate mortgages from 7% last year to 40% now. Butler argues that variable rates are appealing because the penalty for breaking such a mortgage is typically just 3 months' interest, unlike the often substantial interest rate differential penalties associated with fixed-rate mortgages. He also points out that if tariffs are imposed, their immediate impact on the mortgage market would be delayed, giving variable rate borrowers time to switch to fixed rates before inflation forces rate hikes. On the other hand, Tracy Valco from Valco Financial warns that a trade war could cause unemployment to rise sharply, impacting economic conditions more immediately than inflation. She suggests that high unemployment might drive interest rates down faster, potentially leading to an emergency rate cut. This scenario could further bolster the case for variable rates, though it contributes to the market's uncertainty. For risk-averse borrowers, shorter-term fixed rates or hybrid mortgages, which split the loan between fixed and variable rates, offer alternatives. Valco notes that 3-year fixed rates are popular due to their balance of stability and shorter commitment. However, Butler cautions that hybrid mortgages might leave borrowers half wrong about rates, suggesting that if variable rates are the probable short-term choice, it's better to go fully variable and monitor fixed-rate movements closely. The Canadian construction sector finished the year 2024 on a strong footing, with building permits reaching their highest level since 2017. According to Statistics Canada, the total value of building permits increased by 11% in December, reaching $13.1 billion. This growth was primarily fueled by a significant rise in residential permits, which jumped by 21.2%, driven largely by Ontario and British Columbia. In the residential sector, multi-unit permits saw a substantial increase of $1.5 billion, which is a 33.3% rise, bringing the total to $6.1 billion. Single-family permits also experienced a slight uptick, rising by 1.8% or $52.1 million to a total of $2.9 billion. For the entire year, the total value of building permits in Canada rose by 7.8%, totaling $145.3 billion, marking 2024 as the highest annual total since 2017. Permits were issued for 287,100 new housing units, which is the second highest level on record. The growth was mainly attributed to multi-unit housing, which accounted for $34.1 billion in permits, reflecting a 12.2% increase, while single-family permits saw a decline of 30.9%, dropping to $18.6 billion. On the non-residential side, the total value of permits increased for the fourth consecutive year, with a slight rise of $59.5 million, or 0.2%, reaching $36.6 billion. Ontario led the way in non-residential growth, contributing an additional $1.6 billion in permit gains. These figures highlight a strong performance in Canada's construction sector, particularly in the residential market, despite ongoing challenges in the economy. The rise in building permits suggests a robust demand for housing, especially in the multi-unit segment, reflecting urbanization trends and a shift in housing preferences. The Ontario Home Builders Association has raised concerns about the looming tariffs on Canadian steel and aluminum imports imposed by the United States. Scott Anderson, the CEO of the association, described the potential impact of these tariffs as a brutal blow to the housing sector, which is already grappling with challenges like low margins and high input costs. This development could lead to increased costs for key construction materials, further straining the housing market. On Monday, United States President Donald Trump signed an executive order imposing 25% tariffs on steel and aluminum imports starting March 12th. This has prompted criticism from various quarters, including the Canadian Chamber of Commerce. Its president and CEO, Candice Lang, condemned the decision, suggesting it perpetuates uncertainty in trade relations. The tariffs could exacerbate the already high costs of construction materials, impacting home prices in Canada. Anderson pointed out that input costs for materials, such as lumber, have remained elevated since the pandemic. He warned that these tariffs could make Canadian products less appealing to markets like the United States, thereby reducing production and driving up domestic costs. In addition to steel and aluminum, there is concern about potential retaliatory tariffs on other construction materials like cement, gypsum, and lumber. Anderson noted that such measures could drive construction costs to levels that might make building homes economically unviable. This situation poses a particular challenge for first-time homebuyers who might find the prices beyond their reach. The broader economic implications of these tariffs are also significant. BMO economist Robert Kovcich highlighted that Canada's steel and aluminum exports to the United States amount to about $35 billion, representing roughly 1% of Canada's gross domestic product. The impact of these tariffs could ripple through the economy, affecting not just the housing sector but also broader economic stability. Anderson emphasized that the housing sector is already under pressure from various factors, including high interest rates and inflation. The addition of tariffs could further destabilize the market, making it more challenging to maintain housing affordability. As the situation develops, stakeholders in the housing industry will need to navigate these complexities to manage costs and maintain market stability. Aument Capital, a Singapore-based multifamily office, has received in-principle approval for a Category 4 license from the Financial Services Regulatory Authority within the Abu Dhabi global market. This approval marks a significant step for Aument Capital as it seeks to expand its tech-enabled wealth management services to the Middle East and North Africa region. The company, which specializes in tailored wealth planning, asset management, and family office services for international entrepreneurs and affluent families, is now working towards meeting the regulatory requirements to secure a full financial services permission license. This would allow Aument Capital to offer a comprehensive suite of services, including wealth structuring, asset management, and direct investments in venture capital and private markets. Andrew Dalton, CEO and founding partner of Aument Capital Middle East, highlighted the importance of this milestone, stating that the approval positions the firm to deploy bespoke and entrepreneurial-focused wealth management services from Abu Dhabi to the wider region. Dalton emphasized the strategic advantage of having a presence in both Singapore and Abu Dhabi, enabling the firm to bridge investment opportunities across regions and deliver client-centric solutions that meet the evolving needs of today's wealth creators. This development aligns with Aument Capital's mission to address the specific financial requirements of entrepreneurial families and global wealth creators in the United Arab Emirates. The firm's expertise in wealth structuring, asset management, private markets, and venture capital allows it to create customized solutions that align with its clients' individual goals. Today, we're diving into an op-ed piece by Alekia Berry-Sproul, the president of the Toronto Regional Real Estate Board, addressing the impact of taxes on the housing market in Ontario. Berry-Sproul argues that tackling taxes and fees is a crucial step towards increasing housing supply and ensuring more families can achieve the dream of homeownership. The Toronto Regional Real Estate Board has even launched fairhometaxes.ca to advocate for lower taxes on Ontario homes. According to Berry-Sproul, government taxes and fees have become one of the biggest barriers to building new homes in Ontario. Over the last 5 years, taxes on housing have skyrocketed, to the point where 1/3 of the costs a consumer pays for a new home goes to government coffers. Local governments in particular have significantly increased development charges, which have become a major contributor to the rising costs. Berry-Sproul emphasizes that high taxes, fees, and charges from all levels of government are making it increasingly difficult to build and purchase homes. Development charges, land transfer taxes, and various fees can add tens of thousands of dollars to the price of a new home, discouraging both builders and buyers. When housing is burdened with excessive taxes, supply stagnates, affordability declines, and Ontario's housing crisis worsens. To unlock new supply and accelerate home construction, Berry-Sproul suggests that Ontario must undertake significant reforms to its housing tax structure. Development charges, for instance, have far outpaced inflation and construction costs. In Toronto alone, development charges have surged by 102% in just the last 2 years. The financial burden on homebuyers is substantial, with new homebuyers facing over $137,000 in development charges for a single-family home and $113,000 for a townhome. The situation is similar in other parts of the Greater Toronto Area, where municipalities impose development charges ranging from $103,000 to $139,000 on a starter home. Berry-Sproul argues that these charges are further driving up the cost for new buyers, making housing less affordable. Another significant tax burden is the land transfer tax, which imposes substantial upfront costs on homebuyers. In Toronto, this provincial tax, combined with an additional municipal land transfer tax, can result in over $36,000 in taxes for buyers of an average-priced home. While there are rebates for first-time homebuyers, they are based on outdated 2008 home price benchmarks and cover a shrinking portion of the total tax burden. Most first-time buyers now pay over $20,000 in land transfer taxes after the rebate. The C.D. Howe Institute has noted that transaction taxes, like the land transfer tax, distort housing markets by discouraging mobility and raising ownership costs, further affecting affordability. Berry-Sproul calls for bold action to reform how housing is taxed, starting with reducing development charges and reforming the land transfer tax, especially to aid first-time buyers. Berry-Sproul suggests that Ontario should reduce development charges and increase permanent transfers to municipalities for infrastructure projects. This could help reduce the financial burden on homeowners while allowing communities to invest in necessary infrastructure and services. Additionally, Berry-Sproul recommends working with the City of Toronto to reform the land transfer tax, which disproportionately impacts first-time buyers. Increasing rebates or eliminating the tax for first-time buyers would provide significant relief, especially as the average home price in the Greater Toronto Area exceeds $1.1 million. Lastly, Berry-Sproul calls for a comprehensive review of municipal revenue tools to reduce reliance on housing taxes. This review should explore alternative funding mechanisms to ensure municipalities can deliver quality public services without placing excessive financial burdens on homebuyers. Achieving the provincial goal of building 1.5 million homes by 2031 will require addressing the tax burden on housing. With 1 in every $3 a homebuyer spends going to government taxes and fees, costs are rising, and new construction is slowing. Barry Sproul's call to action highlights the importance of tackling taxes, fees, and charges as a first step to increasing housing supply, lowering costs, and making homeownership more accessible. Let's turn our attention to a local story out of Hespeler, Ontario, where a property owner is challenging a decision by the City of Cambridge concerning land severance. This case is now set to be heard by the Ontario Land Tribunal. The property in question is located at 69 Ontario Street, where the owner, Aisha Tariq, applied to subdivide the existing lot into 3 separate parcels to accommodate new residential development. Tariq's plan was to demolish the existing vacant house and create 2 additional lots, each with approximately 10.8 meters of frontage onto Ontario Street, to build 3 single detached homes. Tariq's application was submitted to the city's Committee of Adjustment, where it was ultimately rejected. The committee's decision was based on their assessment that the proposed variance did not align with the city's official plan and zoning bylaw. They determined that the variance was not minor in nature and did not represent a desirable development for the area. Interestingly, this is not the first time a property on Ontario Street has been subject to such a proposal. Less than 2 years ago, a similar application was approved for a nearby property, resulting in the construction of 2 new homes on a previously single lot. This precedent may play a role in Tariq's appeal to the Ontario Land Tribunal. The Committee of Adjustment's refusal followed city staff's recommendation and maintains that the project does not fulfill the intent of the official plan. However, Tariq believes the decision was unjust, prompting the appeal process. As of now, a hearing date has yet to be scheduled by the Ontario Land Tribunal. As this case progresses, it could set an important precedent for future land severance applications in the area. The outcome will be closely watched by property developers and residents alike, as it may influence local development policies and zoning practices. This story underscores the complexities and challenges faced by property owners and municipalities in balancing development goals with community standards. We'll continue to monitor this case and provide updates as more information becomes available.